All right. Good afternoon, everyone. And thank you so much for joining us for another one of our Powerplay Tuesday classes. As always, we're going to go through a few different slides here this morning, and then we will pass off the mic to Mr. Clint Harris, who is here to teach today. So just a quick disclaimer, we are here for educational purposes only. Quest Trust Company does not provide any type of tax, legal, investment, or structuring advice. So it is important that if this is the type of information that you seek, please contact those respective financial advisors to do so. So we always want to put that disclaimer out there. These webinars are strictly for your information. And as always, we'll have this archived as well through our YouTube page if you want to go back and revisit the slide deck. Now, for the full month of November, I do want to touch on our promotion very quickly. We will be covering your very first investment. So if you've not yet opened an IRA and you're looking at a property or maybe some form of multifamily syndication, a note you want to lend on, whatever that may look like for you, if you've identified the investment, then this is a really great promotion for you because we will move forward with going ahead and purchasing that investment on your behalf, essentially meaning that we're going to pay $125 into your account, and that way we can essentially cover that completely for you for that very first investment through Quest. So certainly take advantage of this. We'll leave our contact information in the chat as well. So feel free to reach out to us and we can go through a full consultation with one of our IRA specialists. This is how you can also reach us, or if you are ready to move forward with the consultation, right here will allow you just to go ahead and schedule. If you scan that, it'll pull up our calendar. You can find a time that is convenient for you. We also have our website and our phone number listed down below if you want to take note of that as well. So we have one last social coming up. This is actually tonight. So for those of you in the Dallas office, or if you're looking to tune in online, we have our rental continuum series ending out today. And so this is a series that's focusing on short, midterm, and long-term rentals. So we have experts from all three of these areas coming to talk a little bit about the market, and then they'll be on a panel where you can have a live Q&A with those individuals. So if that's something you're looking to get into, this is a really great avenue for you to ask some of those questions that you may have before you're ready to move forward, or even if you're already experienced. These are individuals who have been in this industry for quite some time and have found some success there. So a really great panel for you to get involved in if you can. Like I said, it is in person in Dallas, but if you wanted to go the virtual route, we will also be live streaming that as well. And we are going to be hosting, this Friday, a virtual online event for QuestCon Live. This is something that we do annually, but this is the first time that we have all women educators talking about the alternative investing industry as a whole. So we're talking real estate, private lending, cryptocurrency, really all over the board of what an alternative investment is going to be. We have experts from those industries coming out to talk to us all day. This is 9 a.m. to 4 p.m. Central. It is completely free to register. Feel free to scan that QR code. You can learn a little bit more about the event, and you can also register through our website. So this is one I highly, highly encourage you to attend if you can. Again, this is going to be this Friday, November 17th. So feel free to register through that link or send us an email and we'll happily get you registered ourselves. And last but certainly not least, for those of you who have been with Quest for quite some time, we have a very large trade style type show that we typically put on every other year. And so we're coming up into 2024 in June, where we are going to be hosting the Quest Expo. This is going to be in Irving, Texas. For those of you not familiar with the area, this is close to Dallas. So if you're in that area or wherever you may be all over the country, if you're looking to connect with other individuals who are in this industry of private investments, so we're talking nothing publicly traded, solely things like real estate and multifamily. So we encourage you to come out. This actually has early bird tickets on sale now. So if you're interested, again, scan the QR code, go visit our website, learn a little bit more about who the speakers and the panels are going to be, and we would certainly love to have you out. And that is all I have as far as announcements go. So I wanted to be very quick here. We're going to go ahead and pass this off to Mr. Clint Harris, and he is going to take it away for us.
Excellent. All right. Well, thank you so much. I really appreciate that. Happy to be with you guys today. My name is Clint Harris. I'm one of the general partners with Nomad Capital. We're a self-storage syndication. Today, I want to speak a little bit about self-storage in general. I want to try to do the best I can to be operator agnostic and approach this from an educational standpoint, talk about some of the pitfalls, things to be on the lookout for, and questions you should be asking operators as you look at self-storage as an industry, a potential investment strategy, and just across that space as a whole. So I am a general partner and operator with Nomad Capital. We have a fairly unique self-storage strategy that we'll get into. On top of that, I'm also a limited partner investor. I have retirement funds that I'm not allowed to invest into our deals because I'm a general partner. It's called commingling. So I've converted those to self-directed funds as well, and I invest into alternative investments as well. So I'm happy to be with you and be part of this community, and very much believe in what you guys are doing. So we'll get started and talk a little bit about some self-storage. So I want to introduce myself and my team. This is the leadership team for Nomad Capital. It's a self-storage syndication founded by a father and son team of Eric and Levi Hemingway, my partners. And then I'm one of the general partners, handle investor relations and capital raising. This is what our team looks like, the structure. We've got a few more interns that have recently come on board to add. We're based out of Wilmington, North Carolina, down by the beach. So I want to talk a little bit about kind of what our strategy is, and more importantly, talk about some things that you should look for with different operators, specifically in the self-storage space. So one thing that's a little bit unique about our strategy is we don't buy self-storage and we don't build self-storage. We specifically focus on buying big box retail buildings like Kmart's, grocery stores, and warehouses, and we convert it to self-storage. So we do development and we just convert those assets from one asset class to another. It changes the formula by which the asset is valued and creates massive forced appreciation. Within the alternative investment space, I think we can all just be aware of where we are in the market right now, that things are a little bit tough. When everything in the market is going great, all the operators look like geniuses. Everybody looks great. When things get hard and interest rates go up and acquisitions get more difficult, that's when the really good operators start to stand out. One of the things I highly recommend that you look for when you're looking across different opportunities with different operators is ask about vertical integration. You want to see where these people are finding their projects. And I don't care if it's multifamily apartment complexes or RV parks or whatever it is, but specifically, you want to look for operators that have some level of vertical integration. What I mean by that is the ability to do the acquisitions and find the properties, hopefully off market, so you're not paying retail costs for the building. If these are forced appreciation properties and you're doing some type of renovation or development, I want to know, are they paying retail costs for that construction, or do they have in-house construction that they can control the costs on? And also the management, again, multifamily or storage or whatever it may be, where's the management happening? And are they paying retail costs for the management as well versus having it in-house? So specifically looking for people that have that top to bottom vertical integration, I think is going to help you identify opportunities that really insulate you when the market takes a turn. So this is an example of what I mean by the conversion properties that we talked about. So the big box retail space, honestly, is pretty much dead. There's very little competition for those bigger buildings, 80 to 100,000 square feet. At one point in time, there was 1,200 Kmart's in the country, and there's none left. But those locations typically have good residential density around there. There's a reason why people in that community would drive to that location to buy their home goods for 20 to 30 years. It's the same reason why a lot of those locations are good for the same people to drive back to the same building and sometimes pay us to put the same stuff right back inside. So this is an example of what I'm talking about, of heavy value add. Anytime you are looking for an investment strategy, an alternative investment, your job is to look and see where the forced appreciation and the value add is. So if you're going to invest into, say, a multifamily apartment complex, there's going to be some way that you're increasing the value. It might be putting granite countertops in and stainless steel and increasing the rents. It could be an operational turnaround from a mom and pop operation to better management. But somehow your job is to identify the value add. So this is just an example of some of the value add that we have, is buying a big empty, this was a printing company that very little appetite for big box space, and converted it to a self-storage syndication, a conversion project on the right. That's what that looks like when it was completed. This is typically what it looks like on the inside of one of these buildings. There's basically 4 different strategies within self-storage that you need to be aware of. There's obviously development. we can all go out and build a self-storage facility from the ground up. Now, it gets a little bit tough, especially with supply chain issues and the cost of construction being up, but that's one of the strategies. If everybody on this webinar right now decided that we were going to partner together and we were going to go build a self-storage facility, you're going to be spending around $120 a square foot for the construction, plus the cost of the land. One of the reasons we like the conversion strategy is across our last 6 projects, when we buy one of these old big box retail buildings or a Kmart and we convert it, at the day that we are cutting the yellow ribbon, standing there with the Chamber of Commerce, we're opening up the doors, we're average 63 cents and 50 cents a square foot. So I think that's an example of the heavy value add that can come from a conversion and the vertical integration that's in place. So to talk about those 4 specific strategies, we've got development. Obviously, it's not rocket science. You're just building from the ground up. We have the conversion projects, which is what we're focusing on. And then on top of that, you have expansion properties. We're going to go through some examples of that. And then an operational turnaround in terms of the management. So we're going to flip through some of the projects that we've done just to talk about the different strategies that you're going to see in self-storage and things that you should be on the lookout when you're vetting different deals and different operators. So the deal on the left here in Kachina is a facility that was a ground up development for us. Years later, we circled back and we've doubled the size of that. We expanded that and built around that perimeter. So all in costs on that from ground up development. And then the expansion was 2.2. And over time, the current valuation on that is 7.7 million. The property on the right is City Storage 421 in North Carolina. This is an example of an expansion project. And typically what you're going to see, the building on the far edge of that screen was an existing mom and pop self-storage facility, and it came with an empty lot next door. So we went in and we built a 2-story Class A facility as well. So the one on the left originally was ground up development, but both of these turned into expansion projects where you go in and once you have at least part of the property stabilized within a market, you review the demand in the market, look at the growth in the area. And if you have the growth there and it meets the standards from a feasibility study standpoint, that's an example of an expansion project and heavy value add that way. The one on the left here, this is a conversion project. This is the picture I showed you earlier. It was an old printing press warehouse that was converted into self-storage. So all in costs on that one around 1.7. By converting it to a self-storage facility, you're changing the price per square foot in terms of the net operating income on the building, and it shoots up the value on the property. Current value on that one is a little over 5.5 million. The building on the right here is a self-storage facility that we purchased that it was an operational turnaround. So it was not climate controlled. And there were some serious expenses there in terms of low pressure sodium lighting. So in that one, we converted it to a climate controlled self-storage, changed it to LED lighting. And that was more of an operational turnaround. That's an example of one that you'll see with a self-storage facility having that significant value add without really changing what it is. You just add climate control and some electric. That's an example of the expansion project. That's the ground up development that we did on the empty lot next door. This is a Kmart conversion. This is an example of, I think this is a great example of kind of where we are in the market. So Kmart's gone. But this is 87,000 square feet of big box retail that was sitting empty in this town. Sitting empty in this town for over 8 years. Very little appetite for that much space. Amazon and Walmart have really kind of wiped out that big box retail space. But these bigger buildings like that is typically where the town is kind of going to grow around there. At one point in time, that was one of the larger employers for the town. So we can typically pick a building like that up for this one. We bought it for 1.5 and we put a couple million into it. And then 5-year valuation is around 8.8. So makes a great location for those same people to drive back to the same building. This is another expansion project. This is a property that we bought at certificate of occupancy. And then on that top edge of that dirt pad, we built a building E, which is a new building over there. Specifically, what you want to look for anytime you're looking at any of these properties is that heavy value add, because that's what's going to end up getting the return to the investors. This is another example of a Kmart in Danville, Virginia. We bought it for a couple $1 million, put a couple million into it. Stabilized value is around 13.4 million. Specifically what you're looking for. This is a great example of what we're talking about in terms of the vertical integration and what you should be on the lookout for. If you find a building like this, if you're paying retail costs for the building off the MLS, if you're paying retail costs for the construction and you're paying retail costs for the management, it's a very, very thin margin. Your job as an educated investor is to find operators that have some kind of benefit that makes them stand out in the crowd and gives them the opportunity to operate in a down market and still be able to control some of their fixed overhead costs. So that's a great example of what that vertical integration looks like. This is a Piggly Wiggly grocery store that was in Macon, Georgia, that sat empty for 8 years, had a hole in the roof. It had rain inside. It had a tribe of homeless people living into it. You take that same building and convert it to a self-storage facility. That's a little under a $4 million project with a 5-year valuation of over $13 million. So again, you want to look at all the strategies available for the value add within self-storage. You've got development, the conversions, the expansion, and then the operational turnaround. And I really don't care what the asset class is. You should be looking for some kind of edge like that with every operator that you guys are looking at and vetting. The deal itself is very important, but we all know that the deal is only as good as the person operating it. This is a conversion project, the old Sundrop bottling facility in Gastonia, North Carolina, 70,000 square feet. It's a $5 million project. Stabilized value is around $14 million. So I'm getting a little heavy on the examples here. We're going to move forward because we got some other things to talk about. This is a warehouse conversion in Burlington, North Carolina, $5 million project converted to self-storage. It's worth a little over $13 million. All right, so let's talk about self-storage in general and why it's important. One thing I think that's really important is to talk about things from a diversification standpoint. So you as investors, your job is to try to create a level of diversification across different assets, different geography, and different operators. So you want to build that into your portfolio. One of the things that I think people are at risk of is where we are right now with really high interest rates. One thing that you should think about is looking to diversify your portfolio across debt structure as well. Right? We always talk about different assets, different geography, different operators. But if you're in different assets, even in different geography with different operators, but all of them, whether it's mobile home parks, RV parks, multifamily, self-storage, if all of the operators that you are invested with are using various forms of variable rate debt, you can still be exposed. When we have interest rates shoot up and they're using bridge debt or anything variable, you have opportunity for your entire portfolio to be affected in a negative way if you have not asked the important questions about the debt structure and what their capital stack looks like. So obviously, I love looking for that vertical integration when I am looking for operators to invest my retirement funds in. Outside of that, I want to look at what the debt structure is. And frankly, one thing that I feel strongly about is I'd like to see a relatively decent equity split for the general partner. I like for them to have some skin in the game where if they do really well, they stand to make a lot of money. That's great. Hopefully everybody stands to make a lot of money. But the way that I look at it is if the deal gets squeezed at all, for whatever reason, it doesn't perform the way that it's supposed to, the larger percentage of equity that the general partners have, I look at that as an insurance policy against them having to do a capital call, right? If the deal adjusts 10 to 15, 20%, and they have 10 to 15 or 20% equity in the deal, there is potential for them to get squeezed out. No operator ever wants to do a capital call. So in a situation like that, they potentially could give up some of their equity or sell some of their equity to make sure that the limited partners are going to hit their returns, because otherwise it's a good way for them to grind to a halt in terms of what they're able to do as operators. I like to see a healthy split where there is room for them to be able to use some of that equity or give some of that equity to the limited partners if need be to stabilize things in a down market. I think that decent equity split for the general partners essentially can act as an insurance policy against having to do a capital call. So from the operator standpoint, those are some of the things that I look for. And those are some of the things that I think that LPs should be asking themselves, specifically looking at the debt structure and asking about variable rate debt, or if that's something that the operator utilizes. So let's talk about this specific asset class a little bit more and why you should potentially think about storage and see what might fit into your portfolio. So across the national average, we've got 92% occupancy within self-storage. It's a $54 billion industry. There's over 52,000 nationwide facilities. It's a very fragmented market. We're seeing it come together really quickly, but most of those facilities are mom and pop operators. A lot of them don't even have websites, and they're kind of small town facilities. We're seeing U-Haul and some bigger players in that space, Prime Storage and people like that, really consolidate. There's kind of a gold rush in the storage area right now, but especially in these smaller secondary and tertiary markets, there's opportunity for players to come in and really kind of take over or develop in underserved markets. So in 2021 alone, remember that was during COVID, 23.6 billion in self-storage acquisitions. 10.9% of all households in the United States currently utilize self-storage. That's not counting businesses. That's just households. Specifically, when you think about the drivers for storage, it's death, divorce, downsizing, relocation for work. Obviously, with COVID, a lot of people started working from home and had to have offices. So they had to move furniture out and things like that. So that was actually really good for storage overall. But the number one drivers are anything that caused people to move or downsize. This is the industry overview. I think this gives a great snapshot of what the long-term performance looks like. So on the left-hand side of the slide, you see REIT performance from 2007 to 2009 during the crash. So during that time frame, the S&P 500 was down 22%. Self-storage was down 3.8%. The middle portion of that slide, you got REIT performance overall from 1994 to 2021. You see, S&P 500 was up 10.8%, self-storage up 18.8% over that same time frame. On the right side here, Marcus & Millichap is a commercial real estate firm that puts out a study specifically looking at things from an inflation standpoint. Obviously, we're in an elevated inflation market right now, specifically looking at an investment strategy and whether or not it is inflation resistant. They came up with this scale. Basically, what they found, there's only one commercial real estate asset that is more inflation resistant than self-storage, and that's hospitality. If you think about it, hotels or Airbnb properties can change their rents on a night-to-night basis. Self-storage is month-to-month. Versus if you're locked into a 10-year triple net lease on a commercial property, that's 10 years before you can increase the rents when you might be getting eaten alive by 7 to 9% inflation. So in terms of inflation resistance and the ability to change those rates, it's on a month-to-month basis, so highly inflation resistant within the self-storage space. This is the industry overview of the total return. If you had invested $50,000 in 1994, today, it's a little anecdotal, but at that same annual percentage of return of 18.8%, it would be worth over $5.2 million. So obviously explosive growth in that market segment. The national average occupancy for storage, most people think they're going to use the unit for 1 to 3 months. That's kind of where they land. The reality is that almost 40% of them end up being in the facility for over a year. Every facility that we have and that we operate, there is someone who moved in as soon as we opened the facility and has been there ever since. That's true for the newer facilities that we have, but it's also true for the facilities, the first ground up development that we did in 2006. We have original tenants who moved in the first few months and have never moved out. So the reality is it's a pretty sticky asset class and one that a lot of consumers get in and stay in. One of the concerns that I had when I started investing into self-storage as a limited partner before I became a general partner with Nomad Capital and made it significant focus of my career specifically on self-storage development was what's happening with the asset class over time. And is it a necessity or is this going away? When I think self-storage, traditionally you think the baby boomers and china cabinets and Christmas decorations, and they're in and out of the facility once or twice a year. But what's happening with the younger generation? Is this an asset class that over time is going to disappear? We spent the money on the studies, and what we found is very interesting. So as of the first year of COVID, the millennials are actually the largest population segment in the country now. They make up 34% of the population, but they utilize 38% of self-storage. However, the way that they use it is very, very different. And this is one of the reasons that I like this, obviously, as an investment strategy for us as operators, but more importantly, as a limited partner investor. I like multifamily and I like storage. And this is the reason why. The millennial population, unfortunately, typically is not buying houses at the same rate that they did in previous generations. They're renting. And when you rent, you're basically renting based upon the size of the property. So what we are seeing is that the younger generation, instead of renting a 2-bedroom condo for $1,800 a month, they'll rent a 1-bedroom condo for $1,300 a month and then get a self-storage unit for $150 or $200 a month. They still have stuff. They still have lifestyle items, but it's more associated with activity. So it's kayaks, mountain bikes, snowboards, wakeboards, winter clothes. So the way that they are using storage is different than the previous generation. They are using it as an extension of the garage, an extension of the closet. Instead of paying for an extra bedroom to keep their stuff, they would rather rent a smaller space. Because they're renting, they don't have an attic, they don't have a garage. They're being pushed out of these more expensive urban areas into these small secondary and tertiary markets, which traditionally are very underserved for storage. So it gives us an opportunity to go in and capitalize that. Because they're using it as an extension of the garage, extension of the closet, it means that if you are going to invest in self-storage as a limited partner right now, the self-storage that you build or that you invest in needs to be several things: safe, secure, well lit, easy access, and climate controlled. Climate controlled is something that they have to have. They don't want mold on their winter clothes. They need to be able to get in and out, because instead of showing up to the property once or twice a year like the previous consumers did, these people are in there sometimes once or twice a week. They need to be able to get in at 6 a.m. on a Saturday morning, get their snowboard and their bibs, and head off to the mountains. Because of that, the traditional model of the office is open from 9 to 5, 5 days a week, and a couple hours on the weekend, it doesn't work. We need QR codes, touchscreen kiosks. Everybody needs easy access and to be able to get in and out of the building. So I think following those market trends gives you an opportunity to get ahead of that consumer behavior and really situate yourself very well in the self-storage space. So that's the emerging trends that we're seeing in the market that you as an investor should be aware of. All right. In terms of the property management, we all know that a deal basically is good as the operator. So I want to see that vertical integration, whether it's multifamily apartment or self-storage. I like to see in-house management and economies of scale come along with that. Specifically within self-storage, one of the things that I like as an investor is if we compare it to a multifamily apartment home complex, that is traditionally, of all the gross potential income coming in off of a multifamily, about 70% of that is going towards your fixed overhead expenses. You have office staff, you've got landscaping, you've got maintenance. The other 30% is the net operating income. With the self-storage facility, it's typically the inverse. About 70% of the gross potential income is your net operating income, and about 30% is going towards your expenses. And as you stabilize and you fill a property, typically your advertising cost is going down. So over the long run, that expense will drop to 19 to 21%. So you have a significantly higher NOI, which is what determines the value of the property. This is an example of ability of people to use either a phone or a computer to rent a unit at any time. And then that middle picture is a picture of one of our touchscreen kiosks in one of our facility where people can literally walk in off the street, create an account right there, touchscreen kiosk, rent a unit, and get in anytime, day or night. I want to walk through quickly a case study of one of the projects that we did, just to give you an idea of some of the questions you should be asking and some of the things that you should be looking for. This is a 15-year-old vacant Piggly Wiggly grocery store that we converted to Class A climate-controlled self-storage facility. It's 481 units, 49,000 net rentable square feet. It's a 60,000 square foot building with about 49,000 net rentable. Just under $750,000 net operating income per year. So this is what it looks like. Total cost, the building plus the construction, we're into it for $4.15 million. The stabilized value, once it hits 60% occupancy, is $11.6 million. The 5-year valuation when it's full is $13.5. It's a big empty building that had some significant issues with it. Here's some of the pictures. This is what it looked like on the inside. A tornado had picked up an AC unit from another building, dropped it on the roof, punched a hole through it. It was getting rained inside for years. It was covered with rats and roaches. It had a group of homeless people living inside. It was horrendous. But because of the vertical integration of working with my partners that are the contractors, we were able to take this on in a lot of ways where there are other operators that would never want to touch this building. If the risk is not worth the reward if you're paying retail costs for the construction. That's why I like the opportunity to look for operators and this is me speaking as an investor, I like operators that have in-house construction where they can take on some scary projects that maybe have higher returns and have the ability to control some of their fixed overhead costs and not let that get out of hand. So those are some of the pain points with this project. Those are the before pictures. Here's some pictures of what it looked like afterwards. Obviously, a lot of these buildings are already sprinkled. We just convert them to LED. We put storage units on the inside. We change the use of the building. It changes the net operating income per square foot. Drastically, obviously, changes the valuation on the property. Usually, when we are finishing up a property, we're usually sitting around 30 to 35% LTV, which gives us some very creative ways to recapitalize in terms of we can refinance the properties instead of having to sell them. So we get to keep our assets. So that's some of the big wins on this project. Just kind of wanted to give an example of what one of those looks like from beginning to end. Typically takes about a year to do the construction on a project, and then about a year to fill it up, and then head towards stabilization. So that's what that looks like. All right. Obviously, with Nomad, we can accept self-directed IRA funds. That's obviously one of the reasons we are partnered with Quest, and we certainly appreciate all the help that they've been able to give us and help us with that. So if you have interest at all in our strategy about what we do, I wanted the opportunity to give people a chance to schedule a call with us, specifically more than anything about our strategy. It's just the heavy value add is always something that you want to clearly identify. No matter who you're investing with or what your strategy is or how you want to build your portfolio out, you need to know where that value is coming from. If it's that operational turnaround that we talked about versus an expansion, a conversion, or new development. Obviously, the new development, it has a much longer timeline. It has significant risk involved with it. So your job is just to weigh the risk reward and where you are with your portfolio and what that looks like for you, whether your goal is cash flow or appreciation over time. And then also making sure that you're focused on things from a diversification standpoint. In my opinion, self-storage is a great way to diversify. And if you're not invested in that space, you should think about making it a part of your portfolio, whoever that is with. But outside of that, make sure you're looking at the debt structure. This is the difference in, betting on a horse versus betting on the jockey. You want to look at the operator, the decisions that have been made. Have they ever had a capital call in the past? If they have, I highly encourage you to figure out why and what they've done to make sure that it doesn't happen again. But more specifically, ask about the debt structure, because you might find, even if you're invested with different operators and different operator classes, if they all are using some form of variable rate debt or bridge debt, you could be exposed. So I think that there's opportunity there to dig in deep, pick the right operators and the right asset classes that you like, and make sure you're building at the diversification from asset, geography, operator, and debt structure as well. And then obviously it gets you the opportunity to pick different projects that are going to mature at different times. It gives you the opportunity to diversify across time as well, depending on what your individual goals are. All right, that's all I have for you today. I certainly appreciate it. Let's go ahead and open it up for some questions and answers if there are any.
We do have a couple. I'm going to go ahead and throw them on the screen here. One from Juan Alvarez, talking about an off-market warehouse for sale and if that could be used for self-storage.
It certainly potentially can. Your number one thing that you're going to want to look for is, does it check the boxes in terms of a feasibility study? The questions that you have to ask are, you want to look at things from, number one, a zoning perspective. Can you get it zoned to work for self-storage? A lot of warehouses traditionally are in an industrial area. You want to be looking at basically residential density in a 1, 3, 5, and 7 mile radius. You want to look at the price per square foot of self-storage in that town. And is it oversupplied? Is it undersupplied? What's the population? How many people are living within that residential density that we talked about? And within that, how many people per household? What's the age? What's the percentage of renters versus owners? Obviously, renters are not going to have the same opportunity with a garage or an attic as homeowners do. So renters is typically a little bit better for storage. But that price per square foot, the price for the conversion, that residential density, is the population of the town rising or falling? Does everybody in town work for one company that could go out of business and drive everybody away? You're basically looking to follow growth patterns. You're looking from a feasibility study standpoint as to what the demands are for the market. That's going to determine if it makes sense for the project to be converted to self-storage. And then if it does, it obviously at that point is going to come down to the cost and how much money you need to spend to get it there, and if the juice is worth the squeeze. There's usually an economies of scale, and if it's a little bit too small or a little bit too big, it may outpace where the market demand is for square footage, or if it's too small, it might just not be worth it.
Great. Thank you for answering that. We got a few more that popped up. One from Stephen Collar asking if you do joint venture deals.
We have done some JV deals in the past when we were doing proof of concept. At this point in time, last year we did 6 individual deals, 2 Kmarts, 3 warehouses, and a grocery store. Now we move to a fund model. So we have investors that come in. Basically, you're investing into a portfolio. So one investment gets you ownership across 5 or 6 different self-storage facilities across the Southeast. We move to the fund model. We're not doing any joint venture deals at this point in time.
Gotcha. Understood. We have one from Debbie asking about any minimum investment amounts if you were to invest with Nomad.
Yes, we do. We have 2 different classes of share. We're a 506B syndication, which means we can accept both accredited and non-accredited investors. Obviously, most people, I think, in the Quest ecosystem are probably going to be accredited investors. But for Class B shares, it's a $50,000 minimum, and it goes up in $1,000 increments. So we have people that will invest with 75 or 128 or whatever. And then we have Class A shares starting at a $250,000 minimum. It obviously comes with a little bit larger percentage of equity, a little bit higher preferred return.
And one final question we have here, although everyone watching that's tuning in right now, if you have any more, this will be final call. Let us know what questions you do have. This one's coming from Steve. How do you evaluate a geographic area, population, and how can you tell if you're oversupplied?
This is a great question, Steve. So I had this conversation recently with the founder of Radius Plus. Radius Plus is a data software that specifically does a deep dive on self-storage and how it is in the area. The prevailing thought was always that you want to look at the amount of square footage per capita in an area to determine whether or not it's over or undersupplied. And that number's varied from time to time. And basically it was, for a long time, it was around, say 7 feet per person. Some markets, they're saying 11 square feet per person. The number's gone up and down. But the reality is, I think the number one factor that determines what the supply looks like in a market is the price per square foot. If people are paying a really high price per square foot and all the markets are full, obviously it's still undersupplied. The number one thing that you can do is get a third-party feasibility study done. We have an in-house acquisitions team that is constantly looking for new deals and running feasibility studies in-house. And then we also verify with third-party feasibility studies as well. A lot of times, if you're using a bank, they're going to require you to do that anyway. So you want to look at that geographic area. So, Steve, I mean, the reality is what really matters with self-storage is about a 7-mile radius. Right. That's about as far as people want to drive for self-storage. Even if you get them a better deal, they're not going to get a moving truck and pull everything out of a self-storage facility and drive it to the other side of town to get a better deal. The reality is they want that proximity, and within reason, they want to stay, price conscious, but they want about a 7-mile radius. That's about how far people are willing to drive. So that's what you need to look for. What's the competition in that space? And what's the residential density in a 1, 3, 5, and 7-mile radius? And then are there any socioeconomic barriers or, that stop you from, is it the town half the town's on one side of a mountain and half of it's on the other side? Then obviously, even if it's within that radius, but there's a big divide that keeps people from wanting to cross a river or whatever it may be, you have to take that into account. But the number one thing for geographic area is population. And then the amount of square footage of net rentable storage that's in the area, specifically climate controlled, and then the growth patterns. We're seeing explosive growth across the Southeast, especially Eastern North Carolina. That's where we're invested. We're across the Sun Belt, Georgia, Tennessee, Virginia, North and South Carolina. That's kind of our footprint because that's where we're seeing massive explosive growth. And as people are getting pushed out of these larger cities into these small suburbs, these secondary and tertiary markets are having massive growth. They're typically undersupplied for storage. So that's where we are coming in and we're buying big box retail buildings like Kmart's, grocery stores, and warehouses and converting them. The good thing about a Kmart or a grocery store and some warehouses, typically you have really good residential density around there. That's why they put a Kmart there, right? That's why they put a grocery store there. So in that situation, it works really well. But yeah, population is your number one driver. But just because you see a lot of square feet per population doesn't necessarily mean that it's oversupplied. You really have to get down to the nitty gritty and look at the demand and then look at the price per square foot to determine, obviously whether or not it can handle more storage. And if it can, that's a really good time to be able to come in with a cheaper strategy like a conversion, where we can come in, buy the building for cheap, convert it, maybe be into it for, 3 to 5 million, but the stabilized value is 13 to 15 million. Nobody else is ever going to be able to come in and undercut your prices when your cost basis is that low. So, yep, listening to the population in that third-party feasibility study, that's extremely important to make sure you're having success.
Thank you for that. And for those of you who are interested in this asset class, that was a great due diligence checklist. So highly encourage you to go back and revisit some of the points that he touched on, because a lot of great information there. We have several questions that have come up, so we have plenty of time. I'm going to throw them up on the screen. This one comes from Joe. What is the exit strategy with the fund?
Great question, Joe. So it's in the name. So Nomad Capital, in our opinion, everybody's here because we're all investing and we're all looking for opportunities to create financial freedom. In my opinion, financial freedom by itself should not be the goal. It should be financial, time, and location independence. Those three things together create an independence of purpose of where you go, where you want, when you want, and do what you want. In our opinion, that's what a nomad is, a real estate nomad. So with that in mind, if we just build properties up and sell them, that doesn't help with that long-term strategy. At that point, you're a house flipper, and the day you stop working is the day you stop getting paid, because we're trading time for money. So within the fund, the way a fund works is you have to put an end date on it so that you can calculate the return. But the reality is our strategy typically within the fund model is we refinance the properties because we're at a very low LTV. So most of the time our investors get their payout by way of refinance, which means it's a non-capital gain. So it's non-taxable, which is nice. And then at that point in time, we hold properties long-term. Within this fund, we're going to have to sell one or two of the properties, but our goal is not to end a fund and liquidate everything. We have to have it underwritten that way so that we can show people what the return is, but we're being very transparent with everybody. Our goal is always a long-term hold. We want to give people great short-term returns by way of refinance whenever possible, so it's non-taxable. There are going to be one or two properties that we need to sell. For the most part, we want to hold our properties long-term. As long as we own them, then investors into our fund continue to hold their equity, and that allows us to continue to create that long-term cash flow to give everybody that time, location, and financial independence that we're looking for. So I'm happy to go into more detail about it than that. Obviously, I don't want to talk too much about it here, but if you'd like to hear more, I'm happy to schedule a call with anybody interested.
Great. Thank you for that. I have one from Dave. He says he is in El Fundo. Anything new?
Hey, Dave, great to see you here. Enjoyed seeing you at the Left Field Investor event recently. Yeah, we've got some new stuff going on. We're closing on the second property in about 2 weeks. So good things. I'll connect with you after this online. Great to see you here.
We got a couple more from Joe. This one asks, what is the current distribution rate for B-share investors?
Great question. So on this project, remember you need to think about this as development. So this is a fund. That having been said, if we talk about an individual property, that's a good way to think about it. So if we take a property, it might take us 8 to 10 months to convert it. I'm going to tell you it's going to take a year, right? So for the first year, there's no cash flow because we're building a property out. Then we got to fill it up. So for the second year, there's no cash flow because we're filling it up. However, you're still earning a preferred return during that time period. It's just back owed. So that preferred return is accruing. At the end of year 2, beginning of year 3, we start giving quarterly distribution. So all the money originally that's coming out of the properties goes to paying the back owed preferred return to the investors. And then year 3, year 4, year 5, you get cash flow equal to your percentage of equity. Then at or before year 5, refinance on the property, return of your initial investment plus another large lump sum. We try to do the best we can to double our investors' money in 5 years, obviously a little bit market dependent. But from there, year 6, 7, 8, 9, 10, you continue to get cash flow. And then at the end of 10 years, a couple different scenarios, we could sell all the properties. That's not our intention. More likely, we could refinance as a portfolio or sell one or two of the properties, make sure we're hitting our return. depending on if you're a Class B or Class A investor, it comes out to a 3.2 to a 3.5x equity multiplier over 10 years, 21 to 24% annualized rate of return. But we get into the details a little bit more, but that's basically what it looks like. And then after that, we continue to own the properties. Everybody that's in continue to own their same percentage of equity with cash flow in the future.
And one last one from Mr. Joe. Are you carrying a variable interest rate only loans, or are you securing fixed rate financing?
There it is. Somebody was listening. Great question. We do not use any variable rate debt. We never have. We don't have to specifically for us. Like I said, we're not doing ground up development, and we're not buying existing self-storage facilities. The buildings that we're buying are so cheap. Traditionally speaking, at closing, they often appraise for $1 or $2 million more than we pay for them. So because of that, the banks are still willing to give us fixed rate debt. If we need to, we'll close a building all cash if we need to within the fund. And then we can just refinance later after we do the conversion. But we never use any variable rate debt, never have. We won't in the future. And that's basically because the banks look at storage in general as a very safe asset class. In addition to that, they're looking at what we're getting and what we're paying. There's very little competition for big box retail. So a lot of these buildings are basically they're worth what we're willing to pay for them. So we're finding them off market deals. We get good deals on the building. So because of that, the banks are still willing to give us fixed rate debt, usually around 25 years. We underwrite for up to 8.5% interest. The reality is, even right now, I think the last one we closed, we were in the mid sixes. So the banks just look at it as a fairly safe asset class and are willing to give us that stable long-term 25-year money. Sometimes it'll have a 5-year balloon. So we'll be lining up ahead of time on properties that we know we're going to have a 5-year refinance. But to answer your question, no variable rate for us.
Great. And I do believe that's the last of the questions we have. We'll close out here, but if anyone has any last minute ones, feel free to use our chat box. First, we want to thank you, Clint, for taking the time this afternoon and coming and talking to us about this. I know there are many investors, both on the IRA side and non-IRA, who are looking for something to park their money in with someone that they trust. So it's great to see, your face up here talking about something that and have experience in. Any last thoughts from you to those who are looking to get started, but maybe a little bit hesitant, again, whether they're IRA investors or not?
Great question. The number one thing I think is education. I think we've got an opportunity now. Education is free these days. And that's why I love the way that you guys have put this community and this platform together, specifically for people looking for alternative investment strategies. The best thing you can have is multiple people putting their eyes on it so that you can get different people's opinions on the operator and everything else. So there's a lot of discussions to be had about, how you're going to underwrite and what operators you're going to partner with. But that's the number one thing. I think to have success in real estate investing, you really have to have three things. It's time, it's experience, and it's money. This is a situation where a lot of people in this community probably have money. That's obviously why they're here, but they don't have time. And without time, you can't get experience. Or if you're a high earning income individual, you shouldn't be spending your time to get the experience, right? You just keep the main thing, use your capital and invest it with somebody else that's willing to use their time and their experience along with your capital to have the success needed to create, a good LP-GP structure and a good syndication offering. So if you're one of those people, the best thing to do is figure out for yourself, how much time do you have to invest? And if you do, great. Maybe the better thing for you to do is go be an active investor. There are people I talk to all the time, and I just tell them, look, with your skill set, you shouldn't invest with us. You should go do something yourself. But the reality is, a lot of times they can get better returns themselves if they're out there flipping houses, but you're going to be trading time for money in order to do that. If that's not you, the best thing to do is to partner with an operator. And in that situation, educate yourself. Things just like this, looking at different operators, asking the questions, looking for the pitfalls, trying to be aware of any traps that you could fall into. And the best thing that you have there is community, and looking to surround yourself with other investors that are asking questions that maybe you haven't thought of, and connect with people in a meaningful way. Because at the end of the day, we're all looking at the deals, but it's about the operator, right? It's the difference in betting on the horse versus betting on the jockey.
That's a lot of really great advice. I think that more than anything, it is going to be utilizing your network and all of those resources that are out there. So we certainly appreciate you coming on today and talking a little bit about your experience and expertise in this industry. As I let everyone know in the beginning, this will be archived on our YouTube page. So I do encourage you to check it out, share it with your network. Those are plenty of people out there that are looking for the opportunity, and certainly some of the interesting information that you have to shed light on as far as due diligence goes as well. So we very much appreciate you, Clint, coming out today. But it looks like that's all we have.
Excellent. Well, thank you so much. I really appreciate you making time for it. And yeah, excited to be working with Quest. Thanks for all you guys do to help with us.
Of course. And bye, everyone. We will see you same time, same place next Tuesday.